Happy Monday, everyone. Welcome to the Monday Market Update. My name is Nash Paradise. Joined with me, as always, or as often as I can get him here, Mr. Andrew Cady. How are you doing today, sir?
Doing amazing. How are you doing today?
Probably better than you. If you don't follow Andrew on social media, you're missing out. Guy had a wild weekend, partying up like he was 22 years old, flying to Miami for concerts and taking the red eye back. No sleep, all gas, no breaks, and yet he is here with us to talk markets.
Absolutely.
And, doing the hard work. I sneeze and I hurt my back, and so went to the Cowboy game this weekend, and all I could think about was how small the chairs are, and like it's basically like sitting on a Spirit Airlines flight for 4 hours. I'm like, this is not comfortable. But proud of you for going hard and having a great time. Speaking of having a great time, let's talk about what happened last week. That's a lot.
That's a lot.
It looks like a lot, but it's not really a lot.
It's not really a lot.
No, what happened last week was we finally got some jobs data. We got some jobs info coupled with ADP data, and let's try to dissect what matters here. Early in the week, we get jobless claims, the continued claims, ADP employment change. So the interesting takeaways there was it wasn't all that interesting. It was pretty in line with all the expectations. 232,000 jobless claims, ADP employment change negative 2.5 thousand. Not wholly significant, not really big movements, but it does show, stabilized trending in a negative direction for jobs. So, okay, cool. We get to Thursday, we actually get some data, get some September data, non-farm payroll specifically that we've been waiting on. And here's where it gets interesting. We come in at 119,000 jobs added versus a forecast of 50,000, which would normally look like a pretty bad beat, except we had a revision from the previous report, 22,000 down to negative 4,000. Not a great revision. And with all that said, unemployment rate actually went up from 4.3% to 4.4%. So we have some diverging data here, a little inconsistent. What are your thoughts and takes on that, Andrew?
It's the BLS. If you guys have watched what I've said at all, it's the BLS. We beat expectations for September's report. It's wonderful. It's so exciting because when we get the next report, they'll revise it lower. It's just how it works. The labor force participation increased, which is really why the unemployment rate went up. It wasn't necessarily that $20,000 report revision for August that caused that. It was more a labor force participation increase that really pushed the envelope on it. But nevertheless, 4.4% unemployment rate spooks investors. It really does. So what could have been a bloodbath in the markets was stemmed off by that. And go ahead.
I was just going to say anything like we got other, projections, some of the jobless claims the week over week, all seems to be telling the same, incongruency between jobs going the wrong direction, but yet adding more. Should we expect that going forward?
I would think we'll just continue to expect it from the BLS. I think at some point investors are actually wising up, which is I think the market's reaction to the jobs report. It spells a little bit. Yes, there was two fighting sets of data. Unemployment rate went up, but it was a good jobs report. But the August report was revised technically 4,000 negative, so not a huge negative revision. But I almost wonder if investors are starting to look past the BLS a little bit and say we know the downward revisions are coming. That normally we beat expectations by double on the September report, or over double. That should have been just a boom, gangbusters for the market. I think investors are seeing through it, and they're like, let's wait and see what the revisions are, which is frankly what needs to be done.
Yeah, I mean, anything, what, 50,000, 75,000 revision wouldn't surprise anyone. You almost got to give BLS credit for that revision from 22,000 to -4. I mean, that's only a 26,000 swing, which for BLS is pretty good.
It's pretty good.
All right. Speaking of, you can't put the BS in without BLS. Yeah, let's get into this week here. It also looks very, very heavy, but it's not. Andrew, what are you queuing up on this week? What looks significant to you?
Well, let me take a peek at it on this screen because it's very hard to see on the teleprompter in front of me.
Yeah, I mean, we've got core PCE reporting for September on Wednesday.
Yes.
That's pretty big. Retail sales coming in on Tuesday. ADP employment change. Just the weekly figures on Tuesday as well. So, like,
yeah, and producer price index could be a market mover on that.
Yeah. I don't know. There's a lot going on Wednesday. We're getting a lot of information: new home sales, GDP deflator, durable goods, building permits, MBA forecasts. Okay, but
continuing jobless claims as well on Wednesday could be a market mover.
Yeah, I almost feel like there's
jobless claims
so much coming on Wednesday that, for whatever reason, the jobless and the continued claims, they're not putting a lot of stock into. It's kind of like medium impact, but I mean, that's just what this aggregator is showing as far as, emphasis goes. I feel like with having a short week coming up into a holiday break, we always see a little bit of, overreaction, especially when it comes to selling. We see a lot of sell-off right before the close of business on a holiday weekend. So if the numbers don't come in the way that we like, Wednesday could be a rough day for bonds and mortgage-backed securities. But man, it's real hard to forecast anything right now. So any advice you'd give going into Wednesday for, loan originators or anyone in the market?
I mean, I think we definitely expect volatility this week. It's always volatile on short weeks, and we do actually have some impactful data coming out. And investors are quick to sell off right now. I think if your client's happy, you lock the interest rate, guys. It blows my mind in the mortgage industry that so many loan originators float interest rates without their client actually knowing that the interest rate's floating. Like it blows my mind. And you may be a loan originator saying, who does that? You would be surprised how often they put this out there. I got you in at a 6.25 rate. You're good. And the loan originators hoping that they can gain back their pricing exception that they quoted. And they're just hoping. And all it takes is one bad move. If your client is happy with the rate, lock the interest rate. Allow everybody to sleep a little bit better at night, knowing things aren't going to get worse. And if you have a tough time having that conversation with your buyer, explain to them that it is simply a transfer of risk. You're transferring the risk of the market getting worse from you to the lender. That's really what the lock is.
Yeah. You got mortgage loan originators out here on a hope and a prayer without really considering what are you risking to save $300-$400, not a month. I mean, total. And the overall cost of a mortgage being what it is, hundreds of thousands of dollars in total interest, shaving $1,000 off closing costs is great. It's a really good idea. But at the risk of messing with someone's monthly payment on an interest rate that they like, and considering we're in a loan that if we look at projections through 2027 and beyond, a stabilized market has interest rates in the 5s where we actually get some balance, get some people out of their golden handcuffs. Yeah, it's really hard to be taking that flyer and that much risk right now. So Andrew Cady says, lock it if you like it. And I happen to agree with him. Let's move on to what's going on in the Fed funds rate. I find this fascinating because you and I have been talking since the last Monday market update. 78.93% looking into a December cut. It was 65% no cut at a couple points last week. Can you?
This is a swing. That thanks to the, what was it? Which Fed chair was it? Williams that came out and really swung this.
There were so many meetings last week, and we're so used to a hawkish Fed that then getting some conflicting info. do you think this is more Fed comments and FOMC minutes, or do you think it's directly tied to seeing that, unemployment jump up to 4.4% and being like, yep, now the
I
Fed has the ammunition they need?
I don't think it's the FOMC minutes at all. I mean, the way I interpreted the FOMC minutes when I read it is a 100% pause for December. Like the
Hmm.
way I read the minutes, Fed is telegraphing a pause. And I still believe, personally, I think we see a pause in December. And I'm going to go against the grain on that. I think the Fed has, I said it a couple updates ago. I think looking back at our previous two cuts, the Fed was looking for a reason to cut. And they were easy to find a reason they're looking for. It's the red car syndrome. When you're looking for a red car, you see red cars everywhere. And I think going into December, the Fed is looking for a reason to pause. And I think there is enough reason out there for them to do that, especially with the most recent BLS report and the fact that we're not going to get a BLS jobs report for October until after the Fed meeting, December 16th. The November Fed BLS report comes out December 16th. CPI for October canceled. CPI for November comes out December 18th. So all of these are coming out after the next Fed meeting. I think the Fed has telegraphed a pause. I personally believe the markets are wrong on this, that we will see a pause. But reading the Fed meeting minutes, it spelled out pause to me. And I think this was Fed Williams, he very, very, very dovish tone in his speech last week. And I think that combined with the unemployment rate going up has investors hopeful, but my gut says pause.
Yeah. Hope and a prayer from Andrew Katie. I think it's funny that, the FOMC, the Federal Open Markets Committee minutes were on Wednesday, and Fed Williams spoke on Wednesday at 1 p.m. at the same time. Then we get non-farm payrolls. Then we get unemployment rate. Then we have a handful of speeches on Thursday of last week, followed by more on Friday, including Williams, Barr, Jefferson, Logan, Collins. And now after the Friday speeches, we have shifted from 35% looking for a December cut to 79%. So I'm going to disagree with my good friend Andrew here and say we will get a December cut. But the big but there is I believe that either way, whether we get one or not, with the lack of data that Andrew just spelled out, we're going to have to work on less to get to it. It's not going to be super well supported. So I expect the Treasury yields to continue to fall into the December 10th meeting like we've seen in the last two times the Fed got together for a rate decision. And then as soon as we get that decision, knowing that we're not going to see another one, what's a forecast here? End of April, possibly June.
Yeah.
It's going to be a while. And I feel like we're going to have some leveling off. Things are even going to bounce up. We've had interest rates increase as of the last, 4, 5, 6 Fed rate cuts, but we have seen things improve going into that. So I'm expecting the same kind of trickle down, Fed cut, pop back up. Does it really matter to the markets if we cut December 10th or January 28th? It shouldn't. I mean, it's a pretty small window, right?
And what's funny is I'm predicting the same thing, but I'm predicting a no cut. I think we actually see the markets continue to trickle down. 10-year close. I think we touched 4% on the 10-year. The 4% Fibonacci is going to be a very tough character to break right now. But if we can break below it, great. But I think we continue to see that leading up to December 10th. I think we get a no cut on December 10th, and we see markets boom back up for 10-year Treasury back up at 410. And I think we get it for the same reason, but I think we get it because of a no cut. And I think the Fed, I'll dive into this a little bit. I think the Fed is also a reason they want to hold, and this is all my speculation, is I think there is a serious bubble going on with AI in the markets. And I think if the Fed cuts too early, they remove their ammunition from their gun to stave off a massive correction. And I think there's a concern for pause right now. I think right now what we're seeing in AI with circular investing is scary. It's really, really, really scary. And if you start Googling and digging into the circular investing, it's insane.
I want to put a pin in that because that's worth diving into because a lot of people aren't really considering what's going on and how the money is moving and some of the overvaluation of some of these companies and how you've got these, I don't call them whistleblowers, but these big shorts are starting to call attention to this, and it's making the markets act kind of funny. I don't want to act like mortgage interest rates aren't that important, but let's breeze through what's going on with interest rates right now. It's a lot of flat, a lot of stable. We're in this same zone after we hit a couple of lows and the 10-year got below that 4% mark. Cool. We're in the same range. 6.34% is the overnight average. It's been flat. 10-year is stabilized a little bit, hovering in that 405 to 410 up to 415. We're on the better side of it, trending in the right direction. Nothing that's going to move anything in a way that's going to, impact or increase the number of home buyers in the market with these ranges that we're talking about. Anything that you would add to that?
No, nothing I would add to that. I just think there's a lot of trepidation in the market, and I think the Fed is going to be cautious, but that's just my thought on it. But I've done a lot of research into the circular investing, and it's scary what's going on in AI. I mean, I'll dive if you want me to. I'll just kind of open conversation on it.
Nerd it up a little bit. What do we need to be concerned with? What are these red flags we should be looking at?
Right. I mean, so let's look at NVIDIA. NVIDIA released gangbusters earning report, like out of control earning report. The stock market loved it, went up, and then immediately they lost 5% of their valuation over the next 2 days. Why? With such a gangbusters, not only a gangbusters earnings report, but a future projections report. Because when you actually begin to peel back the onion, there's a very, very scary scenario going on with really 7 companies right now. And it's OpenAI, Oracle, Microsoft, CoreWeave, AMD, NVIDIA, and data center leases. So really not a company. But basically you have circular investing. You have Microsoft committing to buy $1 billion, and I'm just throwing a number out there, $1 billion of NVIDIA chips, but NVIDIA investing $1 billion into Microsoft. And then you have the same thing with OpenAI. OpenAI says, hey, we'll invest $500 million into CoreWeave, but CoreWeave gets to buy $500 million worth of our stock at 1 cent per share. And so you get this on face value. OpenAI's got, oh my gosh, someone's investing $500 million into us. But the same $500 million that props them up is now going back to the person that propped them up. And you get this circular investing where people like Michael Burry, who called the housing bubble, is saying AI is absolutely going to collapse. And when you start looking at this, the numbers that are out there, 6.3 billion, 7.1 billion, like CoreWeave to NVIDIA, $2.9 billion with a return of 1.3 billion right back to CoreWeave from NVIDIA. There is a lot of really puffed up numbers out there in AI. And I think investors are seeing through it, which is why NVIDIA's stock took a haircut immediately after a gangbusters report.
Do you think it was investors or do you think it was Michael Burry? Because
I think a lot of people follow Burry.
Yeah.
And
but what happened to Burry after the fact, though?
I didn't follow.
I believe he resigned his position, unless I was reading a wrong report. I believe he said he didn't understand. You may be able to Google quicker than me, but unless I saw something wrong, I believe he pulled out of his position of the investment firm. Basically, made a statement saying, "I don't understand this market. I'm not in the best position to lead this. The market doesn't make sense to me right now, the way things are going. It's just, I'm going to step on back."
Yeah, it does look like that's basically it.
So I wonder, obviously with calling the Big Short, I mean, you could see housing coming from a mile away, and a lot of people did. And I worked at Countrywide in 2006. So you could see and feel the way that people were sucking out their equity, homes going up at ridiculous rate. People all talking, like it became a news cycle. What's your house worth now? What's going on? Like, hey, have you refinanced? I remember asking my mom in like 2005, like, hey, did you refinance yet? Like, not even knowing what that was at 21 years old. And then, it took a few years to get there. We're talking about so many tens of hundreds of billions of dollars invested in these data centers and these tech companies that is largely based on future projections of the availability of AI to replace jobs and increase profitability. It definitely feels bubbly to me. It still feels like we're a little ways off from it, but it definitely feels like a bubble that should be a concern for everyone.
It absolutely should. And I think I think we do have to just keep a wary eye on it. I mean, there's definitely a shift that has happened in the markets. I mean, even look at crypto. Crypto has taken a haircut. What was Bitcoin? It went from 124,000 to 83,000.
Yeah.
We've seen some massive haircuts already come in play, and I definitely think we could see, and that's why I'm calling the pause on it. And I love that we have dissenting votes on the December rate cut, because one of us is going to be right, one of us is going to be wrong. I think the Fed needs personally, I think the Fed needs to keep more ammo in their gun right now. If they cut too much early, we could find ourselves in a collapsing market situation due to a bubble bursting, and the Fed not have a whole lot of ammo left to shoot. And then we could find ourselves back in a 2000 position again, really, really quickly, where we have to cut rates to zero and go back to quantitative easing. And then we find ourselves literally just kicking the can further down the road for the correction that ultimately needs to happen.
Yeah, I think it's tricky when we're forecasting out in this, future range. And I always reserve the right to change my mind. I had a different opinion last week until we got, one report, one set of data, and it was just one thing for me is the unemployment rate. And I feel like the Fed's been waiting on something that says employment is not okay. And, I think the ADP reports have been alluding to kind of stagnant employment for a little bit here, but no one cares about ADP data, which is dumb because ADP has great data and they're a lot more accurate than the BLS has been. But whatever, I'm not making decisions there. I do think it's interesting when we're talking about, I have people ask me all the time, hey, will we ever get back into the fours? Am I going to see interest rates in the threes? And my answer is usually the same, not without a major economic collapse, not without a major bubble bursting. And, you saw what happened with crypto last week, and then you saw the residual effects on the S&P 500, erasing $1.5 trillion in value. These are completely unrelated industries, and yet they seem to move together. Do you feel like if we get to this, massive chip AI fake tech world bursting, that it's going to have trickle over effects into everything? We could see an environment in the next few years that, yeah, we need interest rates at 0.5%, quantitative easing, completely different Fed policy to help stabilize.
I 100% think that's the realistic possibility. If you take the core companies in the AI quote unquote bubble, we'll call it, speculative bubble.
Mm-hmm.
They're the ones that are making up the vast majority of profitable companies year to date. And if you collapse out a NVIDIA, a Microsoft, CoreWeave, OpenAI, you start collapsing those companies down, it's going to have a ripple effect to every sector of the market, including crypto. It's going to be widespread, and the Fed will have to take dramatic actions. We could see another 2000 if that happened, where we have the emergency Fed rate cut, outside of their cycle of meetings, cutting interest rates, instituting quantitative easing, essentially manipulating the markets instead of letting a natural correction happen.
Let me ask you a provocative question here. Is that good for your average individual, your average homeowner, the people who are, renting and not yet in the market? If we have a burst, a collapse, a fall, and, dropping interest rates, is it going to be a matter of who keeps their job and who stays that can jump back in? Is this part of our regular market cycle now with as many busts and, bubbles as we've had since the year 2000? Is this something that we just need to be preparing for over the next, 20, 30 years because of how capitalism is structured?
And that actually might be the better question are we going to see massive quantitative easing cycles as part of the normal now? And that's actually a really good question. And I don't know the answer to that, but is it good or bad for the consumer? I think short term, those who are prepared to enter the market quickly, it's very good for them. Long term, I think for those that are not prepared to enter the market in the housing sector, it's very bad for them. And so I think it depends on the consumer. If interest rates tomorrow drop to 2% and you've got money in the bank, you're ready to buy, it's a huge benefit for you. You can buy more of a house, you can get stabilized, you can have a long-term fixed 30-year interest rate, all this stuff. But those who aren't prepared for it, 6 months into that cycle, home values are already driven up because of buyer demand. And so they get on the tail end of it. And we see it for the tail end of people who bought in 2022. A lot of them are in a very tough position. They paid over asking price. It was highest and best offers. and they didn't quite get the 2.75 interest rate. They got like a 3.99 interest rate, but now they're $30,000 underwater on their house because it was highest and best, and they pushed the envelope on it. So I think it's not overall good for our economy to have these massive swings. I don't think it's long-term good. I think it can be really, really good for those who are prepared for it and ready to capitalize on it.
Few individuals can do well and put themselves in good position. Overall, not good. And I would completely agree with that. I would even expand on it and maybe exaggerate it slightly, in that, having been involved in a number of these market shifts in the last 20 years, I mean, my entire adult life, we've seen these happen. And ultimately, who wins best? Corporations, BlackRock, China buying up homes for cash. I mean, we keep losing as a whole. The average consumer, the average investor, there's going to be a lot of people that get a little bit of wins. But when you get massive depression in the home prices in America, you can't compete with billions of dollars. Like the average consumers, average neighborhood, people, some people are going to win. But when you look at all these charts and affordability indexes afterwards, you look 2-3 years after a bubble bursts, and things are worse than they were before. I mean, we're not back to like 2018, 2019 affordability. Income and employment have not improved enough to keep up with inflation that we have right now. You can't really point to tariffs. That's transitory for the most part, but the cost of goods right now, as related to pre-COVID, are directly tied to the, trillions and trillions of dollars spent. That's not going into the pockets of your average individual. It's bad for consumers. And I wonder if this is just part of the regular cycle, which continues to perpetuate the wealth gap and, leads us into this doomsday scenario of you own nothing. Life is a subscription service. And, you've got a monthly subset of bills that this is your everything and you own nothing.
You will own nothing and you will be happy about it. I literally had the conversation with a friend of mine earlier this week. And I think if we're not careful as a country, home ownership will be a novelty in 20 years. Mm-hmm. I think it will be corporations that buy in bulk to rent to the average American, and it'll be very few and far between that people actually own property. I think we could very easily slip into a society where government subsidies offset rents, and everybody the same thing. It's a subscription service for life. Here's your monthly subscription service that includes your internet, your TV, your rent, your vehicle lease, not a purchase anymore. You lease your vehicle, you turn it in every 2 years, and then it ultimately becomes a society where corporations win rather than consumers win. And I think it's a scary but real possibility.
Yeah, agreed. And we're already there. It's just what percentage of the population is stuck in this subscription rental forever, own nothing. And it's increased, and a bubble bursting is going to increase that further. It's going to, for a very short term, help some people jump that gap, but that gap is getting further and further away as things get more expensive. And not good. It is what it is. I mean, we're doing a lot of forecasting, a lot of doomsday scenarios here as it relates to our current real estate market. We're not close enough for any kind of big bubble bursting to say, hey, keep your eyes out, don't make any big moves right now because we're in this trajectory. Like, you'll see those signs coming further out. The initial concern and worry is very, very real. But I mean, to be honest, we're talking about years down the line for something like this to crack. But I mean, we could see signs of it, just like we saw crypto drop, not enough to move everything, but it's worth keeping our eyes on. And I think this is a conversation that we need to keep going and just see what's going on with things. How is the Fed going to react? Do they have enough bullets in the chamber, as Andrew Cady would say? I think they will with a December cut, because it's either December or January anyway. And we would come back next week and see who's more right at that point, and keep having the good chats.
Yeah, everybody have a great Thanksgiving.
Awesome. Thanks, buddy. I appreciate it. I'll see you here soon, and you take care.
Take care.